Hello, everyone. Today, basically I'm using the WebEx to do the recording because after COVID, some of the video softwares doesn't really work very well. So, but the WebEx have some time limits. So therefore, that I will directly using the noted PPT and just take everybody going through all the calculations. In fact, that if you go through the noted PPT directly, you can also understand how we come up with the solutions. Okay, so this video is I think less than 1 hour, and it will be related to the derivative securities trading strategies tutorials. Okay, and a few questions have some typos, so along the way I would also correct these typos, so please do pay attention. And after I correct the typo, I would also upload this noted PPT in terms of option trading strategy tutorials online. And remember, all these questions are very likely to appear similar format in the final mark examination and the final examination. Okay, let's get started. All right, so the first question saying that an investor is very confident that the stock will change significantly over the next few months. So that means the stock market is really volatile. However, the direction of the price change is unknown. So we don't know that whether it will go up or go down. We just think that the price will go very volatile. Which pair of strategy is most likely to produce a profit if the stock price move as expected? So basically, we want to choose the one can earn money when the price goes high or when the price goes down. So not stay static. Okay. Here, in terms of the solution or answer choice, there are some more specific discussions about short or long position. So when we go along the question, I will also explain that. Okay. But there are some typos. For instance, the second one, bearish calendar spread, it should be long calendar spread. Okay, so if we can correct that. So the first choice is short butterfly spread. So when we do the long butterfly is the one we learn in the lecture notes. You long one with the highest K1, you long another one with lowest K3, and then you short two, same K2, which is the medium strike price. That's the long butterfly. And then when it comes to short butterfly, then your diagram will be flip up, okay, which is the opposite. So that means you long two medium K2, and then you short one high K1, you short another low K3. I'll show you the diagram in a minute. So calendar spread, we know is a long time to maturity and short time to maturity. Long at money straddle, which I show you the diagrams here, okay, at the money. So basically you long a call and long a put with the same K. That's the long straddle. And then short strangle is the top down, right? So basically is the opposite, okay, with two different K. So basically, first of all, we can draw the diagram. The first one is short butterfly. So as I just mentioned, you short one with a higher K1. So that's the first one, short high K1. And then you short another one with low K1. We put it K3. And then you go on to long 2 with the median K2, which is the opposite as previously what we learned. Okay, so it created the opposite payoff. So if you can see from this short butterfly, you will earn money when the stock price goes below K3 or higher than K1. Okay, so that case we can make money when the market is really volatile. So choice 1 is correct. Okay, choice 2 is a long calendar spread. So obviously you can see that you will only make money at T1 when the option is right at the money. So this doesn't fit the definition. And then here you will make the profit when you created a reverse calendar spread, which is long the short term to maturity and short the long term to maturity. You can create it the reverse way. So reverse calendar spread, yes, but the normal long calendar spread, no. cannot be the answer for this question. Okay. Option 3, long at the money straddle. That's correct. Okay. We long a put, and then we long a call with the same K1. Okay. So it can create a long straddle. That's correct. As a short strangle, that's the opposite, right? So first of all, you short a put, okay, with lower K1. And secondly, you short a call with a high K2. Okay, and then you are creating a short strangle, which allows you to earn money when the price stays static. Okay, so in this question, we want the one that earns money when the market goes really high or goes really low, very volatile. So therefore, the answer would be A, 1 and 3, short butterfly spread and long at the money straddle. Okay, question 2, which of the following created a bear spread? So remember, yeah, the definition of bear spread is here. Long a high strike price, call, and short a low strike price, call. So it's a vertical spread. Basically, you can create a bear spread by using 2 calls or 2 put options, right? So in terms of using put option, is similar. Long a high strike price, put, and short a low strike price, put. I show you the diagrams here. So basically, you want to choose the one, you go on to long high strike and short low strike. Okay, so if we see all the choice, the only definition fits our terms of bear spread would be D, long a call with a strike price high and short a call with a strike price low. Okay, ABC is not correct. And here I put a correction for A. You have to switch the strike price. You long a high and short a low. For B, it should be both of them are put option. Okay, and then for C, you long a put with high K, you short a put with low K. Okay, so A, B, C are wrong. The correct answer would be D. Okay, question 3. An investor believes that a stock will either increase or decrease greatly. That's similar to the first question, right? Very volatile in the value over the next few months. Believes the down moves is more likely. So basically, we think the market will either go up or go down, but it's more likely to go down. Okay, so thinking that market is really volatile, but down term more likely. So basically, in this scenario, we should go on to take a strike strategy, right? So long a stripe strategy. So take a look of the stripe, which is the B. Okay, so you long one call, but you long more two put options. So this strategy allowed us to earn more when the market is going down. Okay, so this actually expresses our point of view. The answer is B here. Okay, and one thing that I want to explain to you, protected put, remember, is to create one long cash position and a longer put. So you form a protected put option strategy. And at money strap is you long more call, long two call, and long one put, which is answer C. So it's more bullish point of view. And finally, top vertical combination. This is another term to call the short strangle. Okay, so bear this in your mind. Top vertical combination. So combination means that we have a one call, one put options, and vertical means spread. So top vertical, top is the cap. So top vertical combination is a short strangle. So if it's okay, you can make a note here. The top vertical combination is referring as a short strangle strategy. In this question 3, the answer would be B. Okay, question 4 is a calculation questions. An investor constructed a long strategy by buying an April call for $4, that's the premium cost, and buying an April 30 put for $3. Okay, so the first number would be your strike price, 30, and then the second number would be your premium price. Okay, for call option, it will cost $4. For the put option, it will cost $3. Okay. If the underlying share is $27 at expiration, so that's your ST. What is the profit on the option position? So basically what you do is that to form two options position, one is the long call, and remember your payoff rule is maximum ST minus E or ST minus K, 0 minus the premium. Okay, so it will be 27 minus 30, K is 30, right? Actually, I drew the diagram at the back. K is 30. And then minus 4, which is the premium. Okay, so this is out of the money. And then minus the premium. So basically, your call option would end up with minus $4. Your long put is maximum K minus ST0 minus your premium. So K is 30, and then ST is 27. So you earn $3. Minus 3 is 0. Okay, and net is basically position 1 plus position 2, okay? And then it will be minus 4 plus 0. The answer is minus 4. So that's our answer. And then go back to all the choice. The answer would be A, okay? Here to tell you more detail, the first one is long in a call. And then the second one is long a put. Okay, and both with the K $30. So likewise, 1, 2, and here is 1 plus 2. Okay, like I just demonstrated. So the answer is minus 4, which is A. Question 5, consider an option strategies where investor buys option with an exercise price 55 for $7. So it should be buys a call. I'm sorry that there's a patch here, so I have to hide it somewhere. So buy a call with a higher K1 55 for $7. That's the premium. So two calls with an exercise price $60 for $4. That's the premium. But remember, you short 2. So 4 has to times 2 for your total premium income. And buys one call option with an exercise price $65 for $2. Okay, so if the stock price declines to 25, that's the ST. What will be the profit or loss on the strategies? So basically, you have to combine all the payoffs for these 4 positions together. Okay, let's take a look at this diagram because we draw it pretty clearly. All right, so this is obviously a butterfly strategy, right? So you long a call with K1 for $55, and then you short a call for K2, K3 for $65. Okay. Oh, short the code. I'm sorry. Second one is short the code here. Something wrong with my pad. Okay, short 2 codes for $4. So here, remember, 4 times 2, your total premium income is $8. Okay. And finally, you long a code with lower K3 $65 for $2. Okay. So basically, that's your total strategy, 3 strategy, but 4 positions. Okay, so total profits, let's take a look. But here, remember, yeah, ST equals to 25. So basically, we input this ST into your payoff diagrams and payoff rule. So the first one, long call with a K55 and premium cost $7 and ST is 25 is maximum ST minus E0 minus 7, right? So the answer is minus 7 because it's out of the money. The second one is 65. So 25 minus 65 still is out of the money. And then you lose $2 premium, so it's minus 2. And finally, you short 2 calls. Remember, yeah, that case your payoff is minus maximum. So minus maximum 25 minus 60, 0. That's also out of the money, but you earn 2 co-option premium. So 4 times 2 is $8. So the answer would be minus 7 minus 2 plus 8. The answer is minus 1. Okay. Going back to the choice, the answer would be B, minus 1 here. Okay, and then question 6 is a little bit complicated, is currency options. So let's take a look at the question. An American investor holds a portfolio of French stock So this kind of question, you have to identify first of all your home currency, right? So for the American, your home currency is US dollar, okay? And then beta is 1.35 relative to CAC index, which is the French index. In November, the spot price of CAC index is 4750 in exchange rate for USD, 1.25 to 1 euro. Dividend yields is 4%. That's the RF, okay? And then which of the following is the option strategy would be most appropriate to protect portfolio against a decline of euro that week? So remember, yeah, first of all, let's try to draw the diagrams. This is your diagrams. You have the cash position, which was for 10 million euro. Okay, so our risk is when the euro against the US dollar goes down. Okay, because that case, when you translate back to US dollar, you will lose money. Okay, in order to protect this risk, then you should go on to long put options. Okay, this put option would be the currency options quoted in euro to dollar. So this is the currency option we should go on to long a put. Okay, and with the K strike price, that's your strike price, equals to 1.25 euro to dollar. Okay, that's our scenario. Let's go back to the information you have. So here it says March euro options, all prices in US dollar per euro. Okay, strike price, this is the E or K, is 1.25 euro to dollar. Okay, and then call euros and put euros. Remember, that's your premium cost per contract. A call euro is 0.018, and then the put euro is 0.022. This should be quoted in euro. So write it down to dollar again. Okay, so this should be quoted in euro to dollar. That's our premium cost. Okay, so the answer is long put. We know that, but how much is the premium? That's your premium cost. Okay, because in total, what we want to hedge is euro 10 million. So it will be euro 10 million times up. The quotation of the premium is 0.022 euro to dollar. Okay, so cross out the euro, and then the answer would be 220,000 US dollar left. Okay, so that's our premium cost. This would be the answer here. Okay, so first of all, identify your options position in order to hedge the risk for the euro to go down, because this is our income, right? And when we translate it to the US dollar, then when euro goes depreciated, we lose money. So your risk is when euro goes down. That case, you should create a long put options. Okay, so that's the first part, to identify your position in the options. Secondly, just to compute the premium. That's straightforward. The cash amount, 10 million euros, times the exchange rate, 0.022 euro to dollar, and you're able to figure out the total amount of US dollar premium cost. Okay, the answer is B here. Question 7. Take a look at the question. A portfolio manager wants to hedge his bond portfolio. So that's your cash position, the first position, against the change in the interest rate. He intends to buy a put option with a strike price below the portfolio current price. So when you have a put option below the S, that means your put option is out of the money. Okay, remember, because it's lower than the spot. And then in order to protect against the raising of interest, he also wants to sell a call with a strike price above portfolio's current S. So when you short a call and then your K is higher than current S, that's out of the money call as well, because that's higher, right? In order to reduce the cost of buying the put option, because you short the call, so you will receive the premium. This amount premium can compensate your cost in the long put position. So basically, your strategy will be 1, 2, 3 add up together, including your long spot or long cash, including your long out of money put, and including your short out of money call. Okay, so 3 position add up together here. The first one is a long spot or cash. The second one is a long OTM put, because the put options strike price is lower than your spot price. Third one is a short OTM call. Okay, all these 3 positions add up together, we done in the lecture note, is what we call color strategy, right? Remember, it's a color strategy. Next slide, I can show you. This is the diagrams, right? This is the diagram. So a color strategy is to combine with a long bond portfolio, buy a long out of money put, and sell a out of money call. Okay, all combined together is a color strategy. You can see from the diagram. 1, 2, long OTM put, 3 short OTM call, and combined together is the red parts there. Okay, so the answer would be C. All right, so question 8. Consider can you just correct the typo here? It's not bearish option, it's a butterfly option strategy. Okay, so change the bearish to butterfly. This is a butterfly here. Option strategy of buying one 50 strike put for $7, but this butterfly is using put options. So bear in your mind, pay attention to here. Selling 2 42 strike puts for 4 each, and buying one 37 put for $2. So when we computed gain and losses, remember you are applying a put option payoff rule here rather than call. Okay, all options have the same maturity. Calculate the gain and losses, profit or loss per share of the strategy if underlying trading at 33 at expiration. So 33 is our ST. Okay, so you have a long put K1 equals to 50, and then premium is -7, and then secondly you have a short 2 puts, and your K2 equals to 42, premium equals to, pay attention, yeah, 4 times 2 is 8, and you are shorting, so you receive the premium. Third one is you go on to long put with a K3 equals to $37, and because you long, you have to pay the premium. Premium is a -2. That's the scenario, okay? And then we combine these 3 together is your long butterfly, and then we want to compute the loss when ST equals to 33. So just input the 33 into our payoff diagrams or payoff rules. All right, let's take a look. So here you know all the position. The first position is long put at K1 equals to 50. Second one is short 2 put for $4 each. And third one is a long put for $2. Okay. So here, just to combine, write down ST equals to 33, and then insert into all these payoff diagrams. And you will figure out the first one. It's K1 minus ST0 is in the money. So you earn $17, and minus $7, you earn $10. The second one, profit of short 2 put is maximum 42 minus 33 is in the money as well, but we shorting, so we lose money, times 2. And then $8 minus 18, so it's minus 10. And then the third strategy, you long a put at 37, so -2 plus 37 minus 33, you earn $4, -2, you earn $2. So in total profits, that's 1 plus 2 plus 3 would be 10, plus 2 minus 10, so the answer is $2. Okay, so going back to all the choice, $2 per share, the answer would be B. You make a profit $2 per share. Answer is B. Okay, question 9. Which of the following regarding option strategy is or are not correct? So we are choosing the wrong one. All right, and then we go through 1, 2, 3, 4 choices to see which one are not correct. Okay, first one, a long strangle involves buying a call, and a put with strangle should be different. Okay, so the first one is wrong. Second one, a short wall spread involved is a short. The one we learned is a long. Okay, so basically a short wall spread involve basically selling a coal with a lower strike price and buying a coal with a high strike price. That's correct, because the normal bull spread is selling one with a higher strike and then buying one with a lower strike. This is the opposite, so it's a short strategy. That's correct. The third one, vertical spread, is option with different strike, right? With different EOK. So third one is wrong. You basically modify maturity to strike. And the fourth one, a long butterfly strike formed by buying two options at two different strike level and selling another two at the same. That's correct. Okay, but the question wants us to choose the wrong one, so wrong one is 1 and 3. The answer would be B. Okay, here are some correction here. You can refer to this answer. All right, question 10. Which of the following strategies created a calendar spread? Okay, so calendar spread strategy. Okay, calendar spread strategy is to long T2 and then short T1. Okay, that's the normal calendar spread. So just take a look. The only correct answer would be A. Short a call with a certain K and long a longer maturity with the same K. Okay, so that fits our definition. Second one, buy a call with a certain strategy and buy a longer maturity call with the same strategy. No, one is short, one is long, right? So correct the first buy to sell. C, sell a call with a certain price, buy a shorter. No, you should buy a longer. Okay, so when you buy a shorter, this is a reverse calendar. Okay, which means you long a short T and short a long T. So C is wrong. D, similar, buy a call with a certain price, sell a longer maturity. You should short a shorter maturity. Okay, so basically C and D are both representing reverse calendar spread, not a calendar spread. Okay, the only correct answer would be A. All right, so long a long time to maturity and short a short time to maturity. Short T1. And remember, yeah, you would only see these diagrams at T1, right? At the short time to maturity expiration date, and then you make the maximum profit when this option on T1 is at the money. Okay, so you earn the time differences, which is a time value. Okay, the final question. Investor purchases stock at $60 at the same time and sells a 3-month call option on the stock. The short call has a strike price $65 and premium 3.6. Risk-free rate is 4%, break even at the expiration is close to. So basically, you loan a stock and you short a call, right? And then when we short a call, we earn the premium $3.6. So we are figuring out an ST, and then to be break even means net equals to 0. So basically ST will make all your overall profit equals to 0, which means that, to eat off your $3.6 premium income. That's pretty straightforward. Let's take a look at this example here. So your first position is long a stock with your ST equals to 60. Secondly is you short a call, but your K is 65, okay? And then you will earn a premium income. So basically, your break even is that your loss in the spot position will compensate your gain in the options position. So ST would equals to 60 minus 3.6, so it's 56.4. Okay, so as a consequences that when the price goes down, you have a loss in your spot position, but in the meantime, you have some gain in your options position, which is the premium income 3.6, add up together, your overall net profit would equals to 0. Okay, so here, remember, yeah, break even means your net equals to 0. Okay, the answer is 56.4. So here, the answer would be A, 56.4. Okay, so that's the answer. All right, so that's it for all our options strategy tutorials.